Capital structure. So in this section on capital structure, we will cover financing decisions, capital structure decisions, capital structure theories, and dividend decisions. So in this section on capital structure, we will start by explaining financing decisions and then go on explaining cost of capital and weighted average cost of capital. Later, we will see what is capital structure decisions and explain the different financial ratios and interest coverage ratios employed. Towards the end, we will go through some approaches and theories of capital structure and provide basic explanations of capital structure decisions. And then we will cover dividend decisions towards the end. So first, we'll explain what are financing decisions. Financing decisions, we will go on and explain what is cost of capital, which would mean cost of debt and cost of equity. So we have cost of debt, cost of perpetual debt, cost of redeemable debt, cost of preference shares, then comes cost of equity. So until then it is debt and then cost of equity. We explain by two approaches, dividend approach and CAPM, which is capital asset pricing model, and then we will go on explaining cost of retained earnings. So cost of equity and cost of retained earnings will be part of equity, and then we'll also take up and explain WACC, which is weighted average cost of capital. So first is financing decisions. Part of financing decisions cover leverages that we have discussed in the previous sections, as well as financing plan based on leverages that was discussed also in the previous section. It theoretically also includes capital structure, which is what we will cover in this section, along with cost of capital and valuation concepts. So first it is cost of capital. Cost of capital is the requirement of a company to have a minimum return from projects whenever it undertakes capital budgeting projects such as building a factory or a plant. Apart from its usefulness in evaluating an operational criteria to accept or reject investment proposals, both of them are actually subject of capital budgeting. What in fact cost of capital does is it also refers to and remains an important factor of capital structure. As a decision criterion, it is the overall cost, that is, it is the combined cost of specific costs associated with a particular source of financing. Hence, computing of it is overall a two-step process. First, compute elements of costs inherent in different sources of finance or specific costs, and then go on computing overall cost by combining these specific costs. Capital structure defines an equity debt ratio, and then it is relevant to associate specific costs for long-term funds, which includes debentures. Most of it is allocated in capital budgeting investment proposals. Then it is preference shares, equity capital, and then retained earnings. Earnings which are not distributed to shareholders are called retained earnings. So, what is cost of debt? So we have explained cost of capital, and now we will go on explaining what is cost of debt. Cost of debt calculations are easy, since cost of debt raised through debt in the form of debentures or loans from financial institutions can be expressed in terms of cost inflows and cost outflows. So what is cost inflow and what is cost outflow? Cost inflows may be net cash proceeds from issue of debentures or amount of loans minus its flotation costs from specific sources of debts, and cost outflows that are periodic interest and principal payments in installments or in lump sum. However, the interest payments made by the firm may be tax deductible, and it shows a substantial advantage in using debts beyond the indifference point. So indifference point we might have remembered, we have discussed in the last section. So that covers cost of debt. Now what is cost of perpetual debt? Cost of perpetual debt is the rate of return that a lender expects. debt carries a certain rate of interest, as you know. Hence, cost of debt may be coupon interest rate or the market yield on debt and is a good approximation to that effect. Since the effective cost of principal or actually the perpetual debt is the tax adjusted rate of interest, what matters is the before tax cost of debt adjusted to tax effect or after cost of debt. Also, it has to be remembered that bonds and debentures are issued at par or at a discount or at a premium. So we have a example where we actually illustrate these concepts further. It is attached in the reference section. You can take a look at it and understand how the concepts are actually applied. It is mostly self-explanatory. Next, we will go and define what is cost of redeemable debt. Cost of redeemable debt, which is cost of debt for interest paid in installments as well as principal repaid in lump sum at the time of maturity, is expressed by a formula. We'll see what it is. So cost of redeemable debt. So it says cost of redeemable debt is cost of interest in installments. I is a changing number. It is from 1 to n divided by 1 plus kd the whole power t. And cost of principal is COP, which is at the end or towards the lump sum, towards as the last pay, divided by 1 plus kd the whole power n. So that is cost of redeemable debt. So if repayment of interest and principal happens at specific intervals of time, if the principal also is paid along with the interest, the cost of redeemable debt is rewritten as sigma from I equal to 1 to n. COI, which is interest payments, and COP, which is the principal payment. Yet making it together, so it's just added, divided by 1 plus kd the whole power I. I is a changing number from 1 to n. Cost of preference shares. Cost of preference capital may be defined as the dividends expected by the preference shareholders. It's a complex subject because preference shareholders carry priority over ordinary shareholders. If the preference shares are not paid, ordinary earnings cannot be distributed to ordinary shareholders. Preference shares are cumulative, which means if it remains unpaid, it accumulates and the firm will have to pay the cumulative amount before any ordinary shareholders can be paid. Also, the preference shareholders enjoy voting rights if their dividends are not paid, which makes them participate in the management of the company or firm. However, unlike debts, dividend payments on preference shares are not tax deductible because preference dividends are not a charge on earnings. Neither it is an item of expenditure. In other words, they are paid out of after-tax earnings of the company and hence there remains no adjustments to be made in regard to tax for the payment of preference dividends. So also there are two types of preference share capital. Redeemable, where the principal is repaid at a foreseeable future by the company, and irredeemable, where the principal is not seemingly paid back, not until the company is no more in existence. Next is cost of capital. So cost of equity capital. Cost of equity is calculated in one of the two methods, namely dividend approach and CAPM approach, which we actually have given here. Now we will explain what each of these approaches mean in terms of calculating cost of equity capital. Since we'll be explaining that after explaining what is cost of retained earnings. So first we'll go on explaining what is cost of retained earnings. So retained earnings, as was told, is actually the dividends which are not distributed, but that money is retained in the company or firm. So it is not distributed as dividends. Whatever earnings the company has is not distributed as dividends to the shareholders, but it is retained in the company. So retained earnings are earnings that otherwise will have to be distributed to ordinary shareholders, but which is retained by the company so that the shareholders forego their dividends. The dividends foregone by the shareholders becomes an opportunity cost for the company. This is because by retained earnings that belong to the shareholders, The company or firm is expected or implicitly required to earn on retained earnings at the minimum, equal to the rate that would have been earned by the shareholders if it was distributed to them as dividends. This is in fact the cost of retained earnings. Another option left for the firm is to have invested the retained earnings in another firm, having the same risk as the firm which has retained its earnings. Thus, KR is the cost of retained earnings by the firm, and KE is the retained earnings invested in another firm by the external yield criterion, which is E. So, on comparing, KE is equally usable as KR, though the latter, which is KR, may be lower than the former, that is KE, due to dividend payment tax as well as differences in flotation cost. So if it was retained, they would have had to pay the dividend payment tax, and the difference exists between KE and KR in essence. Okay. So that completes the cost of retained earnings. Now we will go on and explain what is cost of equity. Cost of equity may be defined as the minimum rate of return that a firm or company must earn on the equity portion of an investment project in order to leave it alone the market price of an equity share. The market value of share is in a way a return for the shareholders, and so also are dividends which an ordinary shareholder may expect as a return from the firm or company. A stated objective of the financial management of the company also is to maximize the shareholder wealth and market price of its shares, and is the only substitute for wealth maximization of its shareholders. If the company does not pay its shareholders, the market price of the shares may take a beating. Hence, the equity shares implicitly involve a return, and that is actually the dividends which are expected by the shareholders or investors, and therefore it is a cost for the company. Among all sources of funds, equity funds hence have the highest cost and involve highest degree of financial risk. Now let us see what is cost of equity and what does it do. Cost of equity may become tricky and is not as straightforward because first, in the case of debt, the interest that the company pays for debentures or bonds it may be yield, may become the cost of the debt. Whereas in the case of equity, it is the rate of return the shareholders demand that becomes the cost of equity. Now, what becomes cost for a company in the context of cost of equity is the rate of return that the shareholders demand by way of dividend, or the cost associated with keeping the market price of the shares above a certain value, creating value creation for the company and all related factors starting to contribute to the cost of equity calculations. So as I explained, cost of equity is the rate of return that the shareholders and bondholders expect out of their investment in equity stocks and bonds of a firm or company. Also, it is the rate of return in the form of dividends or the market price of shares that is used to calculate the cost of equity. There are different ways one could arrive at calculating cost of equity, and hence we discuss the two methods that are used to calculate cost of equity, namely dividend approach and capital asset pricing model. So we'll see what each of them mean. So first we'll take a look at the dividend approach. According to this approach, cost of equity capital is calculated based on required rate of return in terms of future dividends to be paid on shares. Hence, it equates the present value of future dividends on one share with the net proceeds of sale of one share. The dividend approach takes a calculated look at investors' view on investing in shares, which states investors have a minimum expectation of obtaining dividends while investing in equity shares. So according to this approach, the cost of equity capital is given by the equation dividends per share divided by market price of a share into 100. However, this method of calculating equity capital has some serious flaws. Namely, it does not take into consideration retained earnings or cost of retained earnings, as when the company keeps retained earnings for its growth opportunities, it may give lesser dividend to its shareholders, thereby affecting the market price of its shares and the dividend distributed to its shareholders. The second point is it does not consider capital appreciation into account. It does not take capital appreciation into account, by virtue of which investors may gain a better market price for their shares. Now, we'll try to explain what is CAPM, but before explaining CAPM, we have to see what is the concept of levered and unlevered beta. So beta measures the volatility or systematic risks of a range of stocks or portfolio compared to what exists of each of them in the market. Stocks whose beta is higher than 1.0 is more volatile than the standard and than the S&P 500 stocks. It is also a measure of how much risk a stock contributes when it is added to a portfolio of stocks. To know if a stock has a beta of 1, when the index of S&P moves by 1%, the stock also moves by 1%. Whereas if a stock has a beta of more than 1, when the S&P index moves by 1%, the stock might have moved by 1.5%. That is, it becomes more volatile and riskier, and the expected return from them also may be higher. Normally, tech stocks have a beta of more than 1 and utility stocks have a beta which is less than 1. There is also in existence definitions of levered and unlevered beta that we'll explain now. So what is levered beta? Levered beta measures the risk of a firm with debt and equity of its capital structure, taking into account the volatility of the market. So that is levered beta. Unlevered beta removes the detrimental effect or beneficial effects of adding debt to the portfolio or to the firm's capital structure. So when you add a beta, there may be risk involved. So that detrimental effect, or there may even be some benefits, that also is there. So that we will remove. The detrimental effect or beneficial effects are removed of adding debt to a portfolio or to a firm's capital structure. Now let us go on explaining what is CAPM. So CAPM method is used to calculate expected return of an asset, mostly stocks, given a particular risk profile as well as cost inherent in the form of cost of capital. So the following formula is used to calculate expected returns from CAPM, which is ER of I is equal to RF plus beta, which we explained, into ER of M minus RF. Where ER of I is the expected return, RF is the risk-free rate, ER of M is the expected return from market of shares which get sold in market, etc. And beta is the beta of the company stock, which was explained earlier. Now, the expected return of the CAPM formula is used as a discount rate for the expected dividends and the capital appreciation of stock through market means, so that cost of equity is calculated almost precisely, but in agreement lies the drawback that exists with the capital asset pricing model. So we'll most certainly see the drawbacks while employing CAPM method in the cost of equity calculations. So let us go on explaining what are the drawbacks of the CAPM method. So the main drawback rests on the following assumptions which are made and which forms the basis of the CAPM methods. Namely, the first point is, it's a drawback. Securities market are very competitive and efficient. That is according to CAPM, but which is not always the case. So that is a drawback. The next drawback is markets dominated by investors who are risk aware and rational, who maximizes satisfaction from a return on investment. This is also not a common scenario encountered in capital markets. Weighted average cost of capital. Weighted average cost of capital is the average cost of capital of a firm or company from all sources, including common stock, preference shares, debts like bonds and debentures. It also determines required rate of return that all bond holders and equity shareholders demand in a singular number, who may provide in the firm or company with the needed or required capital. So WACC is also the hurdle rate which investors or the company may look for in a firm acquisition, or maybe the discount rate used in calculating the present value of future cash flows of a company that is part of a future acquisition or an investment project. So it is also the discount rate that is to be used in calculating a firm's net cash flow, which is the difference between firm's present cash inflow and present cash outflow. So it's basically a hurdle rate. It's also a discount rate. Discount rate is used in calculating a firm's net cash flow, which is the difference between what comes into the firm and what goes out of the firm. So that is the net cash flow, and it is a discount rate used for future value of the cash flow. So it's, however, relatively easier for a firm or company to find out the cost of capital when the firm of a company uses only equity to finance its growth opportunities. So when the company uses only equity, it is very easy to find out the cost of capital because it is the rate of return that is given to equity holders as dividends or as market price of shares, which in fact is the cost of equity while using the equity to finance its growth opportunities. Similarly, if debt alone is used to finance a firm's growth opportunities, the cost of debt may be the average yield on bond given to bond holders or maybe the interest on debentures. So cost of debt is also easy, which if only debt is used. But if a company or firms uses a combination of equity and debt to finance its operations, the WACC is found out by weighing the individual components that make the cost of capital according to the formula which is given here. So the formula is E by V into RE plus D by V into RD into 1 minus T, which means the first term E by V into RE, which is equity divided by the total of equity and debt, or which is the volume, into RE, which is nothing but the cost of equity. So that is the equity term. And the debt term is D by V into RD into 1 minus T, which is debt by the total of equity and debt into cost of debt into 1 minus T. T is the tax rate. So that is the debt term. So you have to add these two to find out what is WACC, or the weighted average cost of capital. Now it is seemingly is higher for firms having volatile stocks or risk premium is higher. For fixed income products like bonds and debentures, the discount rate used is risk-free rate of return. Whereas for project where investments are sought, the discount rate used is weighted average cost of capital. Now let us go on deciding weights in WACC and in projects. WACC is weighted average cost of capital. So in WACC, there is this common perception of assigning weights to specific costs, also multiplying cost of each source of financing by appropriate weights and then dividing the total cost, which is weighed by the total weights. So the weights assigned can be historical weights or marginal weights. So let us see what are the different types of weights which we actually assign in the weighted average cost of capital. And we know now that there are two types of weights assigned. One is historical weights and the other one is marginal weights. Historical weights may be market value weights or book value weights. There are two types of them, market value and or book value. Marginal weights, on the other hand, which is not historical weights, there is another one also called marginal weights. So marginal weights, on the other hand, involve weighing the specific cost by proportion of each type of fund to the total funds that are raised. Hence, in the case of marginal weights, it is argued that the weights should correspond to proportion of financing inputs the firm intends to employ, where the combined cost of capital employed should also be calculated by employing marginal weights. The marginal weight system also suffers from a range or series of limitations. Marginal weights do not consider the long-term implications of a firm's current financing and of its financing strategy. This is seen as a serious drawback, and hence many found to shift to marginal forms of assigning weights. Now, hence, most take refuge in historical weights. That is the point. Since marginal weights have a lot of flows, most take refuge in historical weights, where the assumption is that a firm's capital structure is made up of a historical progress of assigning debt and equity in the financing mix. And the so-called capital structure that has so far emerged needs to be taken care of and can only be done by considering its historical weights or values. So in historical weights, the use of market value weights is more appealing than the use of book value weights. This is because securities are exchanged in the market at the prevailing market rates, and so is exchanged at market prevailing rate. The cost of specific sources of finance which may constitute the capital structure of a firm. So however, in the case of retained earnings, this may not hold true, as the actual value in the market paradigm for retained earnings are seen to fluctuate quite widely in the case of firms. So in historical weights, we prefer market value weights than book value weights. And retained earnings, about that may not be considered in the case of this type of weighing the costs. So that may not hold true, as the actual value in the market paradigm for retained earnings are seen to fluctuate quite widely in the case of firms. So this completes the topic which we have discussed, which is basically assigning weights in WACC. So that is also covered. So we have almost covered most of the topics under financing decisions. Thank you.